As an advisor, speaking about diversification with your clients can be tricky. When the markets are going up and you're in a diversified portfolio, your clients are going to be complaining, why did you diversify them? On the other hand, when markets go down, they're going to want to know, well, why didn't we have more diversification?
When advisors have a conversation with their clients about what portfolio makes sense to them, we encourage them to be very explicit about the trade-off between diversification, the benefits of diversification, and the potential issues that come along with it, particularly the ability to stick with something that may feel uncomfortable in the near term to benefit from it in the long run.
We get ourselves stuck on just stocks and bonds, and by bonds, really just treasury bonds. But it's important to note that there's a whole plethora of different asset classes out there that should be explored and should be added to portfolios, at least to some degree.
Of course, it makes sense to diversify your investment opportunity set, to have more breadth, if you will, rather than less. A US-centric 60-40 would be a good example of something that has very little in the way of breadth, as opposed to a fully diversified investment opportunity set that may include emerging market equities, bank loans, and things well beyond that.
When your clients are looking for things to buy, things to add to their portfolio, ways to invest, talk to them about valuation levels. For instance, the S&P 500 right now is trading at a CAPE ratio above 30. That's the highest it's ever been, except for the tech bubble in the late 90s. Explain to your clients, are they really comfortable adding more to something that's already expensive?
And we have to acknowledge the fact that investing is personal, is emotional, and as a result of that, we have to find the right balance between seeking returns and ensuring investor comfort to make sure that the outcome is one that investors can tolerate.
We have a number of tools on our website that can be helpful. For example, we show a set of efficient portfolios, the so-called efficient frontier, that come from our expected returns for a broad set of asset classes. You can then look at these efficient portfolios and their diversification compared to the portfolio that your client holds today.
When we look at a 10% volatility portfolio, that portfolio may have to tilt into asset classes that are not familiar.
You don't have to be completely mainstream or completely diversified into a whole bunch of different assets of which you've never heard of or would never really want to own. There's a happy medium, and this is the trade-off that investors can make.